Good afternoon, everyone. Welcome to this rundown for global stocks for the 20th of December, and this is the final video for this year. So I wanted to not only look at what's driving markets in the very short term, but obviously how things are most likely to unfold in 2016. Now, they'll never unfold exactly as you expect. But at least if you remain focused on the main fundamental drivers, at least it gives you a pretty good idea. We've just got a lot of short-term volatility in the market at the moment. So, you've got to look past that really short-term noise at present to make sense of the market, that's for sure. So let's have a look at the general backdrop, because it's, you can't look at stocks, individual stocks, or even markets without having an appreciation of the bigger picture these days. Otherwise, you can just be completely on the wrong track. So just in terms of general backdrop, the S&P index has remained in no man's land for pretty much all of 2015, and so is the Australian market to a very similar degree. So it's neither been a bull market or a bear market, and in America, as you'll see, it's just been a really long sideways grind, and the market hasn't really gone anywhere much for the entire year. The majority of market participants have turned negative. That's been building all year, but it's really been finished off in the last couple of months with the plunge in the oil price. And now these issues are rising in the high yield junk bond market. Now, this was always going to happen. This shouldn't be a surprise to anybody that has an understanding about risk. Markets, particularly credit markets, have been mispriced for a number of years, and all mispricings eventually return to normal. So this was always going to happen. It's just we didn't know when it would start, but it's pretty obvious that it's started now in the last couple of months, and I would expect that it will continue to play out over at least the next year, possibly 2 years. Now, at this stage, it's impossible to say how that will play out. If it remains fairly calm and orderly, then global equities will not be affected, and they'll be priced according to the fundamentals. If it gets untidy, which it has the capacity to do, but that's probably the less likely outcome, then stock markets will be highly volatile. So the question is, for 2016, is the negative sentiment warranted? Is the majority of people, the fact that they're negative, is that warranted, and are they correct? And we're going to go into a bear market because that's what most people are saying. Or is this in fact a good time to buy? So I think that is the absolutely key question for 2016. Now, when we've had previous interest rate increases, and I've talked about this many times this year, previous interest rate increases on a medium to long-term view have seen the US market rise for at least 2 years following the start of the interest rate rising cycle, and sometimes as much as 3 or even 4 years. The average is 30 months. So to say that the market, the people that are saying that the market is going to go into a bear market because the Fed has started raising interest rates, it's just plain wrong. It is completely non-factual. So the start of the interest rate cycle will not have an impact on the stock market over the medium term. However, it's not unusual for stock markets to be a little bit unstable for the first month or two after that interest rate rise. So the US market could dip, and some people will then point to that as proof that we're into a new bear market. There might be another reason for that, but it certainly won't be the fact that interest rates are going up, that's for sure. Well, when you add in the oil price that has really got people thinking that there's going to be, and in fact there will be bankruptcies and defaults in the energy sector. There's no question about that. And we've already seen a couple of high yield bond funds have halted redemptions, which is a pretty serious event. So I'm not trying to gloss over this and say that it's not a big deal, because it is. But the question is whether it is just going to be a short-term transient issue, and we've seen so many of them this year. People were fearful about China. They were fearful about the Fed raising interest rates. They were fearful about Europe. They were fearful about terrorism. There's just been so many things, and in the end, the market gets a bit upset for a few days, and then it just returns to normal. And as I pointed out last week, the S&P index has fluctuated within a range of 14% this year, top to bottom, and that's one of the lowest ranges of all time. So when you add in the oil price and the junk bond fears, it's no wonder that we've seen the volatility that we did, particularly in the last week. Now, high yield bonds, I've been referring to these on a number of occasions. This is a serious issue, but in terms of comparing it to the issues of 2008, it's just not even on the same league. So that in itself will not cause a very significant issue like we saw in 2008. The wild card that we don't know about is that the liquidity in the corporate bond market is less now than it was several years ago. That's because regulations have forced certain major banks and other major players from the market. There are now less market makers making a market in all sorts of financial markets, not just stocks, but also bonds and currencies. So there is no question that there is a lower level of liquidity in these markets. And therefore, if you get some panic selling into a less liquid market, then you can't be sure where it's going to go. So for me, that's the wild card. But I step back from that and I look at what the Fed has been doing, and whether you agree that the Fed should have been doing what they've done over the last 7 or 8 years or not, is not the point. The fact is they're in the wings. They've got the biggest and deepest pockets in the world. And I can't imagine that they're going to be unwilling to let 7 years of concerted effort get blown up by a liquidity issue in the bond market. I believe they'll step up. If there is a requirement, the Fed will step up. Now, I'm not saying that's a good thing, because all it does is forestall the eventual, significant unwinding in the market. And I'm a firm believer that very significant unwinding and an event probably as bad, if not worse, than the GFC will eventually occur. I just don't think it's going to occur in the next year or two. So keeping it all in perspective as a general backdrop, the short-term noise is unpredictable. We don't know how that's going to play out. And when you look at what happened last week, three big days up and then 2 days to go back to the same point, and we've been seeing that sort of volatility now for a few weeks. No one can predict where that's going to go in the short term. But beyond that, medium to longer term, markets trade on earnings. And I think the key thing is that there's good reason to expect that in America in 2016, corporate earnings are likely to be higher, where we'll see less impact from a rising US dollar. I'm not saying that US dollar won't go up, but I think it'll go up at a slower rate than what it has over the last 12 to 24 months. Corporate balance sheets are really in great shape. They've got a stack of cash on their balance sheet, and if profits are rising, then they'll be adding more cash to their balance sheet. So there is more good reason to expect higher corporate earnings in 2016 than we saw in 2015. Now, just to kind of wrap it up, these 2 charts here, this is American data from the Investors Institute. The top chart shows the percentage of investors that are bearish, and you can see that it's been on the rise of late and is getting towards the top of its normal range. And the one below is the bullish sentiment, and you can see that's towards the bottom of its range. It's almost never lower than where we are currently. These are not the conditions for a top in the market. A top in the market is when people are highly bullish and a relatively small number of people are bearish. We've got exactly the opposite. These are just not the conditions under which market top forms, because so many people are fearful of the market that there's a lot of money on the sideline, and that's not how market tops form. Market tops form because valuations have reached an extreme, and there's not a lot of new money to come in. That's what creates a top. So we're not in that position at the moment. So to wrap it all up for America, the S&P was down by 6 points for the week despite a lot of volatility. The key supports have held, which is the good news. We've got the VIX index oscillating around 20, which is a little bit higher than I'd like. It's been above and below 20 almost day about now for a couple of weeks. There's some key levels, as I pointed out last week, 1993 and 1965 on the S&P. So let's have a look at the American market. There's the monthly chart. And again, just to put it in perspective, it seems like the market should be a lot lower, but when you look at the monthly chart, you can see that it's it's really not done a great deal. Now, the January is this month here. So there's 2015. I'll just move that down a little bit so you can get a better view. So from the vertical line to the right is 2015 on a monthly chart. So you can see that other than the dip we got in August and September, it's really been in a very, very tight trendless range. Zeroing in on the last week, you can see here we had a major sell-off last Friday or Friday before. We then had a very, very positive reversal on the Monday, strong follow through on Tuesday and Wednesday, including the market's response to the Fed announcement. And then it all turned around and went down again on Thursday and Friday as there was a bit of a rethink. And as I indicated on an earlier slide, it's pretty usual to see that sort of volatility because people aren't really sure what it means and how to play it. And so we're getting these massive moves that are amplified by the computer algorithmic trading programs, and you end up with what we've got. Now the key levels. Here's the 50% retracement of the last run. That's at 1993. You can see that last Monday bounced off that exactly. We've got a lower level at 1965. I'd be a bit nervous if that broke. So that's a key level for me. 1965 is the key level. Turning now to the VIX index, you can see we very quickly came off the highs from August. There's the 20 mark. We got down under 20 pretty quickly. We had one little brief look above 20 in November, and then we've had this last spike, and it's been a bit all over the place. But that's not surprising with the Fed decision, oil, junk bond market. So I'm not too disturbed by that at this point in time. Just looking at the US dollar index, because that has a fair bearing on things. We've run up to the 100 level. Just pan back and give you the bigger perspective there. So this is an important level, but you've got to say that we've had a very, very strong uptrend. We've had a consolidation back to the breakout almost exactly. So this is a textbook pattern. We've gone sideways now since February. So that's consistent with what the stock market has done. But there's every chance that the next move will be to break above this 100 level. And I expect that to happen. Just while I'm here, I'll have a look at the Australian dollar. So you can see we've been forming a range here on the Aussie dollar between 69 and about 74. We're sitting round about the middle of that range, and I would expect that at some point we'll get a resumption of the downtrend. So this is just a consolidation of all those previous falls. The Aussie index, the ASX 200, we had a strong sell-off into Tuesday, down at this basically quadruple bottom. We then got a very powerful turnaround on Wednesday and Thursday, but you can bet your life that our market should be down on Monday. If it's not, that will actually be an extremely positive sign for all global markets, because it'll mean that the American market, and I should add too, the American market, some of the selling on Friday night, you've got to put down to the fact that not only was it the quarterly and yearly options expiry, but it was an unusually large number of put options were open and expiring on the S&P 500 index, a massive level. And I'm sure that that had something to do with the way that the US market behaved on Friday night. So if we get a fairly mild down reaction in the Australian market, I will take that as being a positive, that the smart money understands that what happened on Thursday and Friday in the American market is not the start of a new downtrend, that it's just short-term fluctuation. Anyway, we'll see how that plays out. So the Aussie dollar around the midpoint of the range. This really does defy the fundamentals of commodity prices and the fact that the US dollar is now starting to head up. But I think this is just as simple as this was an incredibly crowded trade, people being long US dollar, short Australian dollar, and also short the euro, that it's just unwinding. There's been some profit taking going on. Australian stocks, the ASX 200 was up by 77 points on the week, but that will reverse itself on Monday, at least partially. The key 49.50 support was tested last Monday. It held. We've got very little in the way of trends at the moment, and this is exactly the same as what I said last week. The best value for risk opportunities exist outside the top 50. If you want to put your money at risk, or at least put your money where it's probably not going to go anywhere, then focus on the top 50. If you actually want to make some ground, you want to make some progress, then you've got to look outside the top 50. So this is very much a market for niche stock picking. There's no question about that. And there are a few opportunities. Turning now to commodities, gold was lower by $8 on the week. And it's surprising that gold was so easy. And again, that shows me that people aren't really that fearful about the bond market. Not really. Because if people really thought the bond market really did pose a very large systemic risk, then the price of gold would be $100 higher than it is at the moment, whereas it's hardly moved. And also gold stocks not providing any encouragement whatsoever. Now, commodities, copper was unchanged at $2.13, and that's pretty consistent with the currency. Crude oil closed under $35 again, and it's impossible to predict where the bottom may be in crude oil, so we've just got to watch and see how it plays out. There's the spot copper chart. You can see we've really done nothing now since early November. So to wrap it all up, some caution is warranted, but there's no sell signals out there yet. A last-minute Christmas rally is still on the cards. You've got to remember that fund managers have still got a lot of money on the sideline, and there may be an attempt to push the market up higher into the end of the year. But look, we don't have much time left, that's for sure. So there's still a good case for optimism in my view. Caution, but optimism. The bond market will cause big fluctuations in 2016, even if it's just about perception. So I'm under no delusion at all that the market is going to be difficult to trade, but it is very tradable, and it's the best opportunities occur when people are fearful, when markets are very very volatile. So I think 2016 is going to be a terrific year for good opportunities, but you're not going to do it just by turning up and buying any old stock. It really requires your skills to be well and truly fine-tuned. A move higher in oil would be a huge positive for stocks. So whether we see that or not remains to be seen, but that would certainly be a real positive. So that's it for 2015. It's been a challenging year in many ways. A lot of stocks just going sideways. A lot of good quality stocks in America are trading well below fair valuations. So there's certainly opportunities. I'd like to take the opportunity to wish all members and also all non-members a terrific Christmas and New Year, and look forward to providing you with some insights into how 2016 may unfold. There's my contact details for anyone that would like to talk to me about the market and perhaps how I might be able to assist them. So that's it for this edition. Cheers.